Trading with volume indicators can be a bit intimidating to those who are not sure how and why they are used. Fear not, my friends, because we're going to crack this egg wide open so you too can understand how to use this tool with ease. We've received quite a few emails over the years specifically around the mystique and misunderstanding of volume indicators. Have you got a few minutes to spare? If so, the time invested watching this may pay in dividends with respect to your trading account balance. We here at Stonehill Forex and No Nonsense Forex don't profile them as often as baselines or confirmation indicators because there are fewer of them, so it becomes a law of averages. Pro tip: a volatility indicator can be used in place of a volume indicator, but you don't need both. And we profile different types of volume and volatility indicators because different data are measured different ways. Before we get into chart examples, we need to cover a couple of things. As a production note, we always test volume indicators against something. Since we're not doing full algorithms here, we'll be using our trusty simple moving average period 20 as a baseline for comparison. How you decide to test volume indicators is up to you. It can be against any baseline, any confirmation indicator, or any combination of indicators. Before we get into the rules, understand that volume does not determine trade direction. Volume and volatility indicators only tell you that sufficient volume in the market exists. Entries, exits, and direction are determined by your other indicators. Learn it, love it, live it. It only gives you a yes, it's okay to trade, or a no, it's not time yet. That's it, yes or no. Burn that into your brain. We have 3 rules when using a volume indicator. The first rule happens when you get a cue from your indicator or algorithm. Once you get a long or short signal, look down to see what your volume is doing. If it does not give you a yes, then you do nothing. You move on to the next thing in your day. If it gives you the yes, then sufficient market volume is present, and rule number 2 states that once you've opened a trade, you no longer need the volume indicator. Get rid of it and clear up your charts. And the final rule is that you never use a volume indicator as an exit indicator. You have other tools for that. Recall that volume is the fuel that powers a trend, so if you're an aggressive trader, you might want to align yourself with Mr. Hetfield's philosophy on the subject. Or, if you're more laid back, then perhaps you think of volume as air under a wing, so something like this. Now that we've gone through all the prerequisite material, let's take a look at a few examples since not everybody uses or is familiar with the same volume indicators. In this first example, we're showcasing the normalized volume indicator. We'll make a few comments before moving on to the next volume indicator. With this below chart histogram style volume indicator, you'll be looking for the bars which cross higher than a threshold level, in this instance 100, as confirmation that sufficient volume is in the market. In the second example, we'll take a look at a below chart midline indicator called silence. In this close-up snapshot, we only consider signals that are above the midline or a zero line in other cases indicating volatility. Those below the midline are indicative of a sideways or range-bound price action, which suggests lack of market volatility or volume. In this third example, we'll take a gander at the Trade the Market Squeeze, or TTMS for short. This below chart color change indicator gives us the green light when to consider a trade. In this close-up and personal snapshot, you can see where the balls turn from gray to green, indicating sufficient volume in the market. Easy peasy. Okay, now that we've looked at 3 different types of indicators, let's try our hand at signal identification in conjunction with volume as a group. We'll show images and note various periods where you pick out the best period to consider a trade. Don't worry about how many periods past the SMA signal the entry occurs. We're all about identifying volume now. Okay, first test. I'll label them as A, B, and C and give you a 10-second timer to decide the correct answer. Here we go. In this first trading quiz, which entry signal is supported by the necessary volatility? Is it A, B, or C? Did you get it? The answer was B. Point A did not have sufficient volume as the signal line was below the midline through multiple signals. and point C would have needed to wait 5 more periods before sufficient volatility was present. Let's try another one. In this situation, we're looking at the SMA20 and the color change type indicator. Same drill. Is the correct entry point A, or is it B, or is it C? It's not B, as the color was red and would remain red for an additional 3 periods. And it's not C, as it too would have been an additional 3 periods before signaling green. The correct response is A. We've got price crossing above the SMA 20, and looking down, we see that the color of the ball is green, so good to go. Alright, let's look at one more example. Here we've got a classic histogram style indicator. We'll set it up the same way with 3 choices, A, and B, and finally C. Here we go. The answer is not A, as the histogram is still red when price crosses the SMA 20, and you'd have to wait a few periods. And with B, the histogram is also red in a similar scenario. The answer is C, where we've got the cross and the correct histogram color for that nice run up. Now, wasn't that fun? Not so confusing, is it? Remember, keep it simple. Using volume indicators is not difficult, nor should it be. It's just the final step you need to verify before opening a trade. No mystery and no special equipment needed. Don't go away just yet. We've got a couple more important things for your volume trading education. Another pro tip, albeit old school. While marking up your practice charts can be high-tech Jetsons flying car coolness by using embedded charting tools on your platform, but sometimes it's just easier to go original gangster, trader that is. Take screenshots of random charts, print them out, and use your number 2 pencil and a ruler. Don't worry about calculating ATR and keeping track of wins and losses. This is just a quick sharpening of your technique and signal identification evaluation. Start circling where you feel you would have entered a trade based on sufficient volume. Feel free to tweak settings because you can, and because you can get better results than what the default values will provide. Mix it up a bit. Remember, this is all for you to get better. Now, looking at some of these signals, you might have wondered, the baseline called some decent entries, so why bother using a volume indicator? The answer, my friends, is not blowing in the wind, but that looking at our charts, we have what we like to call backwards bias, meaning that you know what has happened in the past and are making decisions based on prior price action. So, let's take a look at a chart where we don't know what's going to happen. We're going to treat signals with no knowledge of what has happened to see why using volume is necessary. We'll start here. It might be a little difficult to decipher what we're looking at, so I'll insert a close-up of what to watch for. Okay, in this first image, we're identifying the candles with an SMA 20 overlaid in light blue. Notice that in the first 3 candles, we've already received 2 signals, one long and one short. This next image identifies the area below the chart where the indicator lives. The yellow line here is the midline of the indicator, meaning that our indicator signal line in red is below the midline, and that means the conditions for a trade based on volume are not ideal. Now that we're all on the same page, let's get back to the analysis. Look at that. Just a few candles further, we've got 2 more signals, but our volume indicator says no, so we don't. All right, had we taken that last long signal, we'd have suffered through a loss with this most recent short signal where price crossed and closed below the blue signal line. Given that the market is going sideways and the volume indicator agrees, you wouldn't have taken that short signal either. What do we have here? Looks like price crossed and closed above the baseline a handful of periods ago, and now the volume indicator is displaying a signal line just above the midline. Let's see where this goes. Our volume indicator has crossed below the midline. Does that mean exit? You remember the rules we talked about earlier, right? If you do, then you know that you never use a volume indicator to exit. So we press on. That was a hell of a run. Proof positive why using volume can increase the confidence level of a potential trade. You can do this and we can help. By the way, profiled volume indicators on our website have loads of graphics and step-by-step explanation so you won't be left hanging. Check out the website for a lot of great content, and by all means consider the Advanced No Nonsense Forex Trading course to get you dialed in and save a massive amount of time in your trading journey. It'll be money well spent, we promise you. We've got ready-to-go indicators you can download for free in the library, so help yourself at no cost. As a final note, we provide educational material, not financial advice. We'll show you the path, but it's up to you to get off the couch and start walking the walk. Our only goal is to help you become a better trader.